Welcome to the Allan Small Financial Show. As always, I want to thank everyone for taking the time out of your busy day to spend it with us. We have another, information-packed show to bring you today. You know, the markets, last time we spoke, 2 weeks ago, we were coming out of one of the worst performing months, or the worst performing month, April, since last fall, since October of 2023. Worst month that we've seen in general since September 2022. So first negative month since last October, but the worst month since September 2022. And heading into May, a lot of individual investors were a little concerned. You know, where are things going to go? How are the markets going to fare? Should we be sellers into this market? Well, the first 2 weeks of May, here we are, May 15, and the first 2 weeks have been pretty darn good. A lot of the losses that individual investors have took on paper, hopefully for the most part in April, have been made back, and markets are at all-time highs once again. And we're talking all markets in North America pretty much at all-time highs once again. So we're going to talk today about all the different reasons why things have happened, talk a bit about the consumer. So let's put up a list as to what we're actually going to delve into today. Here we go. So the first topic we're going to discuss, CPI. And overall U.S. inflation, CPI, Consumer Price Index. Those numbers out of the U.S. were given to us this morning. Nice surprise. I don't want to say to the upside, because when you're talking about inflation, a nice surprise is to the downside. So we did get lower numbers than were anticipated. So we'll start by talking about that. As always, the top 3 things that individual investors should consider before you make your investment decisions. We have 3 ideas for you to mull over today for the next couple of weeks. Canadian bank earnings. Yes, we are that time once again. Canadian bank earnings will kick off on the 23rd with TD Bank reporting earnings. And then the next week, we're going to get the rest of the banks. So TD actually is kind of front running the rest of the banks. I don't know what the reason is, but the other banks follow the following week. We're going to speak about what's going on at TD more specifically with respect to their regulatory troubles. TD, as many of you might know already, has gotten into trouble with respect to anti-money laundering laws. And unfortunately, the bank is right now under investigation in the U.S. regarding those anti-money laundering laws. So we'll talk a bit about that and the effects of this on investors that own TD Bank stock. U.S. government considering new tariffs on Chinese EVs, among other things. The U.S. government just announced a bunch of new tariffs on a whole bunch of things coming into the U.S. I think it's about $18 billion worth, if I'm not mistaken, maybe a little bit more. And obviously, electric vehicles being the #1 thing that we are focusing on. Many, such as Elon Musk, have said that if the U.S. does not do something, put tariffs on electric vehicles out of China, or just not allow them to come into the country, that the EV market and the car market in the United States would be in trouble because Chinese cars, EVs, electric vehicles are coming in and can come into the U.S. and really at a very low cost, a lot lower than any other electric vehicle right now being sold in the U.S. So something I wanted to talk about on today's show. And the next topic, bad news is good news once again. We've talked about this many times. Good economic data, not so good for the market, but bad economic data or weaker economic data seems to spur on or regenerate or rejuvenate the markets, and the markets seem to go higher on weaker news. Obviously, having to do with interest rates and inflation, weaker economic data means hopefully a slowdown in inflation and interest rates, whereas stronger data has the opposite effect. And lastly, your questions. If you have any questions during the show at all, please put them into the chat boxes. I'd love to be able to answer them at the end of the show. If you have a question and I may not get to it at the end of the show, that's okay. I will try and answer your question over the next couple of weeks leading up to our next show, and or perhaps answer the question on our next show as well. So without further ado, let's get on with the show. So US inflation, interesting. Prior to this morning, I thought I was going to come on the air today and talk to you about how inflation was starting to heat up again in the United States, which was not good for the stock market. We had been given, or we have seen a lot of economic data over the first 4 months, or sorry, I should say 3 months, first quarter of the year, showing us that inflation was starting to move in the wrong direction. We saw headline CPI, or Canadian Consumer Price Index, a measure of inflation, go from about 3%, 3.1 in the US, all the way up to 3.5%. And overall, the feeling was that even the producer price index, another number we got this morning, that data was starting to heat up as well over the first quarter of 2024. Retail sales were much higher. We were getting all the signals that even though the Fed wants to see lower inflation, obviously we all want to see it, so that hopefully we can get to the point where the US does cut interest rates, and hopefully the Bank of Canada can also look to cut interest rates in the coming months. We just weren't getting those signals from the inflation data. However, that all changed this morning, or at least some of it changed this morning. We actually did get producer price index, so wholesale prices yesterday. They showed a slight tick up in PPI, or producer price index, or wholesale prices, so that wasn't good. But today we received some good CPI data, consumer price index data, and that showed for the first time this year that things started to tick down a little bit. We went from a 3.5% reading to 3.4 on the core number, which takes away volatile energy and food prices. We saw a number 3.8 fall down to 3.6. So finally, we started to see inflation move in the right direction, albeit just a small move, but a move nonetheless. And prior to this, we were starting to get a little concerned because we started to see growth overall slow down, growth in jobs slowing, growth in overall GDP numbers slowing. We're hearing the consumer starting to slow down, but yet inflation remained high. And whenever you have slow growth with high inflation, people start to talk quickly about the word stagflation, a stagnant economy with high inflation. And I know Jerome Powell, head of the Federal Reserve, recently said we don't have stagflation. We're nowhere near stagflation as yet. And I agree to a certain degree. Last time we saw stagflation, we saw a lot higher inflation and a lot higher interest rates as well, and much slower growth back in the 70s when we did see stagflation. So we're nowhere near that. So the talk about stagflation was quickly squashed by the Fed and said we're nowhere near a stagflation type of scenario. But nonetheless, slower growth, higher inflation. Hopefully today is the first time that we, as I said, we saw CPI, or inflation numbers, starting to come down. Hopefully it's the start of a bit of a trend. As always, we have some really good charts to show you. Our first chart shows you PPI, producer price, or wholesale prices. You can see here that wholesale prices, total wholesale prices, or PPI, 2.3%. And you can see it actually coming up on the far right-hand side of the chart there. You can see that the 3.4% number is when you factor out, again, volatile food and energy and trade services. You would see here that also PPI has started to tick higher. And that, I guess, in some ways made people nervous yesterday when we got those numbers. And again, hearing that PPI had started to tick up a little bit. The next chart we have is consumer price index, another different measure of inflation. And you can see here, right, hot off the press, our great individuals that work here, getting the latest numbers on our charts from just this morning. 3.6% on core, which you can see here is the more faint line, and then 3.4 is the headline number. So once again, this morning, good economic data showing that inflation is starting to fall. The other thing we received this morning was a number on retail sales. Now, prior to this reading, we've seen pretty strong retail sales right across the board, but we've been starting to hear from certain companies that the consumer isn't doing as well as we thought. And we're just starting to get some of those numbers in the data. And we have retail sales numbers, a chart on that. And you can see here that retail sales, the last reading we received just this morning, again, great up-to-date chart, is basically flat. So those two big gains that we saw in February, March, now flat. Interesting, because that data that we're seeing in front of us right now is starting to match with some of these retail companies are telling us, whether it's an Amazon, whether it's a Starbucks, a McDonald's in the food industry, whether it's a clothing company, or whether it's a company that sells everything like Canadian Tire, for example. They're all telling us that, yes, the consumer is still spending, but spending a lot less and looking for bargains. So retail sales falling quite a bit as well. Next chart that we're seeing that we have is US GDP, or I like to call GDP, gross domestic product, US growth. And what you're seeing here is that those pink bars, you can see on the right-hand side, a nice from the top left moving down to the bottom right, as we see GDP or growth slowing down to 1.6. And the faded bars to the right of it, you're really starting to see are the gray bars, approximately what the expectation is for the rest of 2024. So you're seeing that between 1.5% and 2% is the expectation for the growth rate in the US for 2024. Next chart we have jobs. And as I mentioned a couple of Fridays ago, we saw a disappointing jobs number, 175,000 jobs created. Once again, if you look at the data from about December, so the bar just before January, and if you take a line going from December, it's a pretty much top left to again, bottom right, a straight line, almost diagonally down, with the exception of the March number, which is kind of an outlier, I believe. You're seeing jobs growth decline. We're still seeing jobs growth, but definitely declining. And so overall, what that tells me is that finally, we're starting to see inflation, the inflation data that we were hopefully expecting to see with today's number that we got out of CPI. Hopefully, a little later on, when we get the PCE number, consumption and expenditures number, the number that the Fed looks at more closely, even more so than the CPI, we're going to see inflation coming down as well there. And so hopefully that will start to match what we're seeing overall, which is a slowdown with the consumer, slowdown overall in the economy. And again, hopefully we can see inflation numbers coming down, I guess, over the next few quarters. Now we come to the part of the show where I discuss what I believe is important for individual investors to consider before you make your investment decisions. And, for all of you that are perhaps watching the show for the first time or maybe have missed this part of the show, I like to talk about top three things that I believe are important to look at or focus on. The first, navigating mixed messages by the Federal Reserve with respect to rate cuts. We've heard a lot of mixed messages. There are a lot of Fed officials that come out and speak to the media on a regular basis. Some are saying, well, we still believe we could see a cut depending on the data. Some are saying we may not see a cut at all. And some have even alluded to the idea that maybe the next move is actually a rate increase. So a lot of mixed messaging. We'll speak about that and the importance, obviously, on the stock market. The next topic I think is important before you make your investment decisions, and you're going to wonder why I'm putting just one stock up there, and I've done this before, is the stock by the name of NVIDIA. Why do I put NVIDIA up there? Because it has been and still is the main driver of technology, big cap tech. And as we know, as goes tech for the last year and a half or so, goes the rest of the S&P 500, being the largest component of the S&P 500, but goes pretty much all of the North American markets as well. So NVIDIA has become third largest company in the world, largest chip maker in the world, and it is, in my opinion, one of the keys to this market. And they're going to report earnings in a week's time. Third topic that I wanted to talk about is the insight into the consumer. How is the consumer faring? How are they doing? We know the consumer makes up about 70% of the US economy, so extremely important. The health of the consumer in the US and Canada, for that matter, is extremely important to the stock market. So I think it's a good idea to keep one eye on how the consumer is faring. So let's move on and talk about our first topic, navigating all these mixed messages by the Federal Reserve. And as I said, we've heard from many Fed officials talking about how they see things playing out going forward. For the most part, the good news is that most Fed officials have not spoken about rate increases. They've said that they can see interest rates staying longer, higher for longer, as we say. So that seems to be a constant for most Fed officials. Jerome Powell, head of the Federal Reserve, has also said recently that he sees interest rates staying longer for higher for longer, but not seeing that or not thinking about raising interest rates, even though inflation has remained stubbornly high, much higher than he thought it would be at this point in time. One of the first charts I wanted to show, or one of the things I wanted to show actually, is the U.S. Federal Reserve funds rate. This is the funds rate. This is the interest rate that the U.S. Fed is keeping interest rates at. And you can see it's in that 5.25%, 5% range. And they always give a range. They never give an exact number. So 5.25%, 5.5%, that's where it's been, as you can see, for quite some time. The line on the far right-hand side of the chart has been fairly flat, have not raised rates in quite some time. I think it's last time we raised rates was, I think, July of 2023. So we've been steady for quite some time. And right now, at least, the good news is U.S. Fed is not planning to raise rates. And I think the fact that they're not planning to raise when they announced, when Jerome Powell made that announcement, the head of the Federal Reserve, markets actually liked that and actually went higher, even though he didn't say anything about cutting rates and when that will happen. He spoke about not raising rates, and that was good enough for the market to move higher. I actually have a few quotes here that I wanted to bring to all of you today from the Fed, the head of the Fed, Jerome Powell. First quote we have, we can pull that up on the screen. There it is. And he said recently, "We do not expect this to be a smooth road, that is, bringing down inflation, but these inflation readings were higher than I think anybody expected." This is Mr. Powell speaking. What that has told us is that we'll need to be patient and let restrictive policy do its work. So Jerome Powell, head of the Fed, and I guess for the Federal Reserve in general, they believe that interest rates are in restrictive territory, that interest rates being at these levels in the United States are high enough that they're going to slow down the markets, slow down the economy enough to bring down inflation. So they talk about restrictive territory. We also at times talk about neutral. At some point, the Fed will bring down interest rates into that quote unquote neutral territory, whatever that means or whatever that rate is, perhaps 3-4%, where you're not restrictive, but you're not promoting or becoming stimulative to the economy. So right now, the Fed believes they're in restrictive mode or restrictive territory. Eventually, they will go to neutral mode. And if the economy should falter, they may cut even further to be stimulative to the economy once again. I have another couple of quotes here, again, from the Federal Reserve, Jerome Powell. And here it is. He said recently, "I don't think that it's likely, based on the data we have, that the next move that we will make would be a rate hike. I think it's more likely that we'll be at a place where we hold the policy rate where it is. Is inflation going to be more persistent going forward? I don't think we know that yet. I think we need to know more than a quarter's worth of data to really make a judgment on that." So this is the head of the Fed and Jerome Powell, and he main message here that he doesn't see rate hikes coming anytime soon. So mixed messaging, because we did hear some Fed officials talk about a possible next move being a rate hike. We have heard some economists saying that inflation is going in the wrong direction, that they may need to hike before they lower at some point down the road. So again, a lot of mixed messaging. However, for the most part, and here we have a quote from the Kansas City Federal Reserve chairman, or head of the Kansas City Fed, and Jeffrey Schmidt. And he says, "Over time, I expect inflation to ease back towards the Fed's 2% objective. I am prepared to be patient as this process plays out. However, nothing is certain, and continued vigilance and flexibility are necessary." So overall, I think the Fed, even though we've seen or heard some mixed messaging out of some Fed officials, the talk or the message out of the Federal Reserve is still unanimous, and they're still saying that they believe that they will stay at these rates. They believe these rates are restrictive, and that eventually we will see inflation head down to that 2% target. Is a 2% target a realistic target? Well, I think many people have argued that point. You've heard what I've said before. I don't think it is. I think a more realistic target for today's world and today's economy is more in that 2.5%, 3% range. So maybe we're not as far away from that, or a good scenario as we think. But a 2% target, in my opinion, I just think we're going to have to see a lot more slowdown, a lot more negative economic data if we plan on hitting that 2% target. But that's just my opinion. We'll see how things play out. The second point I wanted to discuss, and I think is important for individual investors to focus on, are the upcoming NVIDIA earnings. And as I said, NVIDIA is the most dominant tech name today, although someone would say, well, Microsoft and Apple are bigger companies. I would say yes, but NVIDIA is clearly driving the bus at this point. Artificial intelligence is the one area. It's a big area, an up-and-coming area, an area of the markets and the economy that we're all talking about. Artificial intelligence is really driving the market higher. And the main company that designs the chips to power artificial intelligence is NVIDIA. And next week, if NVIDIA tells us that things are great, that business is great and continues to grow at a rapid pace, I think that's going to be a win-win for the stock market, because NVIDIA will go higher, other chip stocks will go higher. We know the chip stock area is a big component of tech stocks. Tech, largest component of the S&P 500. All these things go higher, the S&P will go higher, and that will take up the Dow, the Toronto Stock Exchange, the NASDAQ, all the other North American indices, and indices around the world as well, in my opinion. We have a chart on NVIDIA, which I wanted to show. This is a shorter term chart. This is just a 3-month chart. And you can see the volatility in NVIDIA stock. We saw what happened around the 3rd week of April. NVIDIA lost quite a bit of their share price. And it begs the question, a lot of investors would say, oh, I'm never selling NVIDIA. It's a name that, I'm gonna stick with, be married to perhaps over the long term. And that strategy obviously has worked out in the last few years, but I think you need to always keep an open mind. I think you can never go wrong taking a profit. I'm not saying you got to sell out of the name in total, but if you're someone sitting on a big gain in NVIDIA shares, perhaps you take some profit off the table and move it elsewhere. I think that would be a good idea. I think that is good on a risk management basis, trimming some of the profits, moving them to another investment idea. You still want to own NVIDIA, I think, for the longer term. A lot of the analysts have targets well over $1,000 a share for this company. You can see here, stock, when we took a snapshot, was trading around $9.13. I can tell you, last time I checked this morning, stock was up another $25, trading in and around $9.35, $9.40. So getting back to its previous highs of $9.74, $9.75, where it topped out most recently this past April. But again, I think trimming some profit as it moves higher is it just makes sense, I think, from a risk management perspective. Next chart we have on NVIDIA. This one is a year-to-date chart. You can see a little longer. The trend is definitely from the bottom right to the from the bottom left to the top right, and you can see here how well NVIDIA has done. Again, the clear winner on the stock market, on the S&P 500 this year. Yes, there have been a number of stocks, some of the meme stocks, if you follow that the last couple of days, up a lot more than NVIDIA, but I don't really regard those meme stocks too much, put too much emphasis on them. I think that's kind of a quick flash higher, and then we're already seeing these stocks falling. But if you're looking at some of the biggest names, some of the best quality names on the S&P 500, NVIDIA has definitely been one of the biggest movers, if not the biggest movers. And lastly, NVIDIA. Where has the growth come? How is the growth? What does the growth look like? We have a chart here. NVIDIA revenue worldwide from fiscal 2017 to 2024 by segment. And you can see in 2024 how much higher NVIDIA revenues have been. Unbelievable. And you can see where the growth has come. Compute and networking making up most of the growth, the line green there. The dark green is graphics, and the red part is GPUs, which is it's just starting to grow now. And pretty soon, I think GPUs will become more and more part of NVIDIA's growth and money making for the company. GPU is obviously important for artificial intelligence, and we've talked about that on our previous show with Bob Tapscott regarding GPUs and AI. So a lot of you watching the show would know a bit about that just from watching our show, which is a great thing. So keep an eye on NVIDIA earnings next week. I think it's going to be a key that day, especially to how the market behaves, and a key to the market going forward. The third point, final point that I wanted to, I guess, talk about today is this idea of insights into how the consumer is faring. I think if you're an investor today, you want to say, well, the consumer is doing well, so I think it's a good time to invest. Or maybe the consumer is slowing down or not doing as well, and maybe it's a time to be a little bit more cautious because, as I said, the consumer makes up about 70% of the growth in the US and a very large component or percentage of the growth here in Canada as well. And what we've been hearing and what I showed you just recently, retail sales were really strong. As we saw, the recent retail sales number out of the US this morning showed just flat retail sales, no growth, which caught the market by surprise. Again, bad news, but one that the market actually didn't mind to see, because hopefully it'll bring down inflation. But we've been hearing from a number of companies in a bunch of different areas. First company that we have a chart of is Starbucks. And yes, Starbucks has a lot of problems, not just in North America, but in China. They've seen growth slowing down in China because China growth in general slowed for quite some time, although it has started to pick back up again. But we've heard from Starbucks that even in the United States, their largest market, same-store sales are definitely down. The casual Starbucks client, so not the diehards that only buy Starbucks coffee, but the casual person that goes in every now and again to buy a Starbucks coffee or a Starbucks product, we're starting to see that they're the ones that aren't attending Starbucks stores as often. And you can see how it's been reflected in Starbucks. Stock is probably one of the uglier looking charts we have. And I know a lot of investors are in Starbucks. Starbucks has been a mainstay in the retail space sector for quite some time, but it's definitely fallen on hard times. New CEO there is looking for answers. We've seen interviews with the new CEO, and unfortunately, they didn't go so well. So Starbucks is telling us that the consumer is slowing. Next chart we have McDonald's, a name that we all know. There's a McDonald's everywhere, just like there's a Starbucks seemingly everywhere in the United States. McDonald's is everywhere as well. And here you have a chart on McDonald's. And again, McDonald's not doing well. Their last earnings were not so great. They were blaming their earnings misses on the fact that what's going on in the Middle East and areas of the world where there are wars and really areas of the world where the United States is not looked at too favorably. And so a lot of people have been boycotting US products, not going into their store, not going into McDonald's, etc. Because obviously you think of McDonald's, you think of the United States, of course. So that's what they said. But I'm going to tell you that it's more to it than just that. They are seeing same-store sales falling. A lot of people are complaining that you could get a much cheaper meal than what McDonald's is offering and getting the same sort of things at another location, another place. So maybe McDonald's in the future will be cutting prices. I'm not sure, but maybe that is something to watch out for in the future. McDonald's cutting prices to get things back on track. Next chart we have Walmart. Now Walmart hasn't reported as yet. As you can see, the stock has been relatively flat after we saw its 2-for-1 stock split recently. Stock has not done a whole lot. Walmart reporting tomorrow. Big number, because Walmart, largest retailer in the world, they're going to tell us really a lot about the health of the consumer today. And consumer obviously shops Walmart. We all shop at Walmart. The good thing about Walmart, and slightly maybe skew the numbers a little bit, is their grocery side, because Walmart does have a very big grocery business. And because of that side of their business, they've been able to do a lot better than other retailers that are more just apparel and other things. So groceries have been quite strong. Just take a look at Loblaws, for example. They've had some really good earnings over the last year or so because groceries are so strong. And obviously, we've seen prices go up due to inflation. So grocers have made fairly well. Last chart I believe I have here, actually, no, second last chart, one on Home Depot, another retailer, another area for the market showing or telling us how the consumer is faring. And we know the housing market is not faring so well. Higher interest rates, people aren't buying homes right now. The market is definitely slowed. What happens when you buy a home? Well, you tend to renovate. And where do you go to renovate? Home Depot. A lot of people are renovating their existing homes, but even that has slowed. Interest rates are high. Anyone who needs to borrow money to do anything right now, they're just not doing it. They're holding off their plans. And so Home Depot has definitely felt that. And we've seen their stock, as you can see here, pull back. Although I will tell you today, Home Depot stock is up significantly, which is nice to see for all you Home Depot shareholders. And the last, here it is, the last chart that we have, one on Target. Target is, again, one of the largest retailers in the United States, mostly apparel, although they do lots of other things. And other than groceries, they don't really do much there, but they do apparel, they do toys, and they do makeup, and they do electronics. So they're a nice gauge of the market, maybe outside of the grocery area. So it'll be very interesting to see or to hear what Target reports next week with respect to how things are faring. You can see Target made a nice run into around the, I would say, 170, 180 range, but has since pulled back in and around 160. And so Target earnings will be very important to let us know how the consumer is doing. And one of the last charts we have on this topic in general is a topic on the consumer and what their inflation expectations are. And it might be a tough chart to see here, but on the right-hand side, overall, you could see that a little tick higher. So what that's telling us is the consumer in general expects inflation to be moving higher in the coming months and quarters, which is not good. I think the consumer is starting to get really negative. You know, once upon a time, hoping inflation was coming down, but now negative on inflation, thinking that inflation will tick higher in the coming months and quarters. So something to keep an eye on as well. So overall, in my opinion, you want to look at what the Fed and what the Fed governors are saying. Obviously, we have mixed messages out of the Fed with respect to when that first rate cut, timing of that first rate cut, when it's going to be. You want to look at NVIDIA next week, and you want to take a look at all these retailers, what they're reporting, what they're saying, what their CEOs are saying. You want to take a look at the consumer in general, how they're faring, and what their expectations are going forward before you make your investment decisions. Canadian bank earnings just around the corner. We will kick off Canadian bank earnings with TD Bank. They're going to report, I believe, on the 23rd. It'll be very interesting to see what they say and what kind of earnings they report. Overall, in my opinion, Canadian banks, well, we really haven't heard much from them recently, other than TD, which we'll talk about shortly. Royal Bank doing extremely well. They keep doing well. Their recent acquisition of HSBC, I think, is going to help their earnings. Haven't heard much about which banks may increase dividends. Don't know if we're going to see or get a dividend increase from any of the banks. We know that banks in general raise dividends 1 or 2 times on average per year, which is great, which is why it's such a staple for Canadian investor portfolios. You get the bank stocks moving higher over time. Most bank stocks, start on the bottom left and move to the top right on a chart. But more importantly, perhaps for many investors, they always seem to increase their dividends over time. We have never seen a Canadian bank cut dividends since we've been keeping track. So hopefully we will continue to see bank stocks do well. Last quarter, I think the best report was out of Scotiabank. Their restructuring is really done well, has really gone well. So we'll see what Scotiabank says. But overall, U.S. banks reported pretty good earnings, in my opinion. Some of them sold off after the earnings report. But I think the earnings out of the U.S. banks bodes well for what we're going to see out of our Canadian banks. And as we know, the economy is slowing down, so numbers will be slightly muted. But I think Canadian banks still can report some good earnings. And we have a couple of charts to show you here. First one is on Royal Bank. Royal Bank stock has done extremely well. Stock now, dividend is just under 4%, trading near all-time highs, really. Just a whisker from all-time highs in around $142 a share. Highs we've seen closer to 150. So not too far off. And second chart we have on Scotiabank. Scotiabank is going to report a week after TD. And you can see how Scotiabank has slowly moved to the downside. But most recently, coming out of the fall of 2023, Scotiabank stock has started to move higher once again. Couple the cheap price of Scotiabank stock with a 6.5% dividend yield. And I think you have the makings of a great income and growth, or growth and income investment idea. And again, for those investors that can handle the risk that Canadian bank stocks bring to the investor, that the average risk that these ideas have in a portfolio, if you're okay with the risk, I think you can look at Canadian bank stocks. We're all going to be watching. Bank stocks will report, as I said, starting on the 23rd, and then the remaining will report just before month end. So I'm looking for some good things out of Canadian banks, led by Royal Bank, of course, and they'll kick off, as I said, on the 23rd with TD Bank reporting. So anyone who has owned TD Bank stock over the last little while, I'm sure you've heard that they've run into some regulatory issues. They were fined recently by FINRA, governing body here in Canada, $9.2 million for not going by or not having the best anti-money laundering, or not following the anti-money laundering laws. And we know all banks follow the laws, but there have been things that have slipped through the cracks, most recently at TD Bank. And unfortunately, things have happened where now the regulators in the United States are looking at TD Bank in the US as well. There was a drug money laundering event that went through in the United States, in New York State, and went through TD Bank. We've heard, not sure if this is true or not, it went as far as actually bribing some of the TD Bank employees to get this money through, to get the money laundering through. And right now there's an investigation going on. The hope is that this investigation won't take too long to get the results of. But TD Bank shareholders, people that work at the bank, and really individual investors in general in Canada are a little concerned, because TD Bank, when you think about the stock, it's such a large company. It's one of the largest companies in the country, in Canada. It's second largest bank in our country. So like we saw, for example, back in the days of Nortel, when Nortel sold off, TD Bank is in so many mutual funds like Nortel. Now, I'm not going to say it's another Nortel, because we know what happened to Nortel. And I do not believe, and I stress, do not believe TD Bank will go the same way as Nortel went. But we could see some pretty big fines charged to TD Bank. Some people are talking about as much as maybe $2 billion in fines. They also might be put into the penalty box and not allowed to do any deals in the United States, which would be very troubling for the bank. As we know, TD Bank has made a number of deals. They actually have more branches in the United States than they have in Canada at this point in time. So depending on what happens with this investigation into money laundering in the United States, we could see TD Bank stock affected. Now, if you're a shareholder, what should you do? Well, I'm a shareholder and I have done nothing as yet. In fact, for those that are looking to buy a name like TD Bank slightly cheaper, because when this announcement about what was going on came out, stock fell about 12%. You could have picked up TD Bank on the cheap. Yields for their dividend actually shot up to about 5.6% for TD Bank stock. I think their dividend is secure. I'm not worried about that. So I thought that when this news came out, and I still think that based on what's going on, that TD could be an opportunity to buy a good quality name at cheaper levels. So as an investor, if you own it, I probably would recommend you continue to hold it, see how everything plays out. Perhaps if things get worse for TD, you could see the stock falling more. So if you want to play it on the safe side, maybe you want to wait before you buy the shares. For those that want to get in thinking that maybe some good will, or at least not the worst case scenario will happen, maybe you buy TD Bank in front of the announcement. So a lot of different ways to invest at this time in TD Bank. But in my opinion, I think it's still a good name. It's a good name to own. I've already been a buyer for some investors recently after the news came out, buying the stock on the cheap. And I will look to continue to buy for those investors that can handle this volatility going forward. The government is, United States government, that is, considering tariffs, or actually put through tariffs. They've actually gone through. So it's now a done deal, as I believe, on a lot of imported goods from China. Now, interesting enough, when we hear this kind of thing, can't help but to wonder how quickly it will take for China to respond. And they have, and they say they will retaliate, and they will do something in response to the high tariffs that the United States is placing on a number of things, of which one of them being electric vehicles. And of course, they're doing this because the electric vehicle market out of China, well, buying an electric vehicle in China a lot cheaper. The manufacturers in China are building these vehicles, and they're selling them for a lot cheaper than the rest of the world. Tesla, for example, Elon Musk, as I mentioned earlier, saying that if something is not done in the United States or by the United States, then Tesla is going to have a tough time competing against these Chinese EV makers and other companies as well, European companies, other U.S. Car manufacturers, Ford or GM. They're already losing money per vehicle that they're building because they can't charge enough for the electric vehicles. Only Tesla in North America seems to be making money here. But with BYD and other Chinese car makers, they're building cars. I don't know how much money they're making per car. There are some that are saying they're not making any money at all, but they continue to flood the market with cheap electric vehicles. And that is definitely, or can definitely, hurt a lot of the automakers out of the US. So electric cars or electric vehicles, we've seen tariffs go up significantly with this most recent announcement. We have a chart, our first chart here, which kind of goes through all the different things. We actually can see here in the blue, you can see what the current tariffs are, and you can see what they're jumping to. And you can see the first one, which is electric vehicles. Their tariffs have gone up 100%. So from 25% to 100%. Huge, huge increase. Semiconductors, chip makers, 25% to 50%. Solar cells. You want to, use solar as another form of energy. Well, that's gone up as well, doubled from 25 to 50. Syringes and needles. We talk about Becton Dickinson, largest producer of syringes in the world. U.S. company. They've been feeling the effects out of what's coming out of China, most recently in a flooding of syringes into the market. Well, now the United States has gone from 0 tariffs to 50% tariffs. Who's a benefactor of that? Becton Dickinson, BDX on the New York Stock Exchange, in the New York exchanges, how their stock actually went up a little bit when this announcement was made. So you can see here how all these different areas are now going to have higher tariffs. Some of them didn't have tariffs at all. Some of them now have 25% tariffs put on them, 50% tariffs, or in the case of electric vehicles, 100% tariffs on electric vehicles. And tariffs are never a good thing, in my opinion. When they are placed, it just adds to possibly inflation in the United States. You hope that when they put these tariffs on, that there is no retaliation from the Chinese, but that's wishful thinking. It's this tit for tat situation that we seem to get. The U.S. does something and China retaliates and does something back. And in a couple of shows from now, we're actually going to have an expert on geopolitical events, the whole China-U.S. story. So stay tuned for that coming up on our show in mid-June, June 13th, I believe. And we're going to have an expert in that field. And we're going to talk to him about what's going on in this war. I call it a war between China and the U.S. You put a tariff on me, I'm going to do something to you and China. You don't send us your best chips out of the U.S. Well, we're not going to let you, have your Apple iPhones in government buildings and things along those lines. So this tit for tat, this higher, this battle between the United States and China, in my opinion, is something we all need to continue to focus on, especially now that these tariffs have gone through. So bad news has become good news once again. And the reason for that, simply, every time we get some weaker economic data, the market tends to move higher because it believes it's getting closer to that day where the Federal Reserve will cut interest rates. And I'm not so sure that that is the right, right idea or right way to think. I think, in my opinion, I still believe you want to see strong economic data and at the same time have inflation fall, but maybe that's wishful thinking. You can have strong data and have inflation coming down. So there's that fine line that the Federal Reserve has been walking for quite some time. And so when you get a day where jobs growth disappoints, and we have a chart here on the S&P 500 that will illustrate this. This chart shows how the S&P 500 has moved up, but on a day, which was May the 3rd, by the way, so just at the start of this rally, we saw 175,000 jobs created. A bad number because we were expecting 240 or well over 200,000 created that on that report. So a weaker jobs number, and the stock market took off and hasn't really looked back since. So weaker data once again is proving to be very good for the stock market. We saw retail sales numbers this morning, weak out of the US, but again, a positive for the market. We're seeing GDP come down from 4% where it was back third quarter of last year, all the way down to 1.6. Probably don't want to see it fall too much below that, but 1.5%, 2%, if it can reside or stay in that area, I think that'd be good for the markets because it's a not too hot, not too cold number and allow inflation to come down. So once again, bad news continues or is now becoming good news for the stock market. And as we move forward and get more and more data, as we continue to hopefully see things slow down, not by too much, but just slightly slow down in the coming quarters, the hope is that we'll see inflation slow down and that perhaps the Federal Reserve and Bank of Canada, for that matter, can be closer to, at some point, cutting interest rates and getting closer to that neutral standpoint versus a restrictive one, as they've been talking about over the last 6 months. Another part of the show that I like best, where I take some questions from the audience that's watching. If you have a question, please put it into the chat boxes. Be happy to answer them if I don't get to them this show, because I can see I already have a few questions to answer. Definitely get to them the next show or in the next couple of weeks leading up to our next show. So a lot of questions here, actually. Wanted to maybe answer one question that maybe is a little different than what we've had in the past. The question goes like this: with Donald Trump doing so well in the polls, how does this affect the stock market? Interesting question, because it's actually a question I get from time to time. Who do we want to win the next election? Is it a Joe Biden or is it a Donald Trump? And really, I think the answer is it depends. Obviously, it's going to depend on the policies that these individuals put through while they're in office. It's also going to depend on who they ask to surround them. What type of people are surrounding the president and what ideas they're bringing to the forefront. But anytime you get a change in president, a Democratic president becomes a Republican president, we find the markets actually do best in that scenario. So I guess the easiest way to answer that would be if we see another Trump presidency or President Trump takes office once again, that historically would show a good or be good for the stock market. I think that both individuals have spent a lot of money trying to stimulate the economy. We've seen tax cuts by the former president, President Trump, that are still in place till today, which has helped the stock market. So I guess the overall answer is, I guess it depends. Republican presidents usually outperform Democrats. So if you want to go by the numbers and by the stats, in my opinion, having a Republican in office definitely outperforms a Democrat in the White House. So with that, I want to conclude our show by saying thank you so much once again for tuning in. I hope we gave you some good information that you can take with you before you make your investment decisions, some information that you can possibly focus on when you look at the ticker or watch the news. Remember what we said on our show, what really matters, what's really driving this market, and hopefully we leave you with some information along those lines. So Thanks again for watching. We hope you tune in 2 weeks from today on Wednesday, Wednesday, May 29th, not March, Wednesday, May the 29th at 12 noon. So same time, same place. And until then, happy investing.